Hey everybody, this is the Greenlight Retirement Show, and I'm your host, Brian Lindbergh, and we have Tim Fitzwilliams, Corinne Fitzwilliams, and Ron Wright. How are you guys doing?
Good. How about you guys?
Doing great, Brian.
How you doing down there in Florida, Ron?
Yeah, it's always a good check-in. How's the weather down there?
Nice and sunny. We've had some pretty intense storms of late, but
oh, really?
It's beautiful today.
I take it over the allergies that I get this spring for sure.
No pollen.
So,
I'll have to make another visit down there.
Any day.
But yeah, Tim, I mean, we wanted to kind of get started with Ron and chat a little bit about some of the current events going on out there.
Market news, Ron. So our chartered financial analyst, Ron Wright, who manages our portfolio with Fitzwilliams Financial and Fitzwilliams Wealth Management, would love to hear what you have to say on recent market trends.
A softball.
Well, you know, it's been really boring out there lately. It's been one of the most incredible periods that I've ever seen. You know,
Really?
The volatility has been astonishing, and then out of that, suddenly we have 10 straight days in a row of hitting new up days in a row, which is, it's either a tie for a record or it's a record. I'm not sure. I don't keep those records, but it's incredibly unusual to have a streak like that. You know, off the bottom, a big streak up like that. But the problem is that it has been going up on nothing, on no real news, nothing really to propel it other than anticipation and hope that things are going to get better.
Right, because
and at the same time, things aren't.
Right, so let's talk about that, right? So things are going to get better. Well, last quarter GDP was down, so that's 50% through the official definition of a recession. So what are you seeing as notable earnings reports, and how do you feel like our GDP is going to turn out for this quarter?
Right, so we're seeing sort of two extremes on the earnings reports. You've got companies, some of the tech companies are coming out with pretty good earnings reports. Some of them are coming out with poor earnings reports, but they were expected. Nobody expected Apple to come out with a phenomenal earnings report given their position in China and the tariffs and what's going to happen there. But you had some others, some of the semiconductor manufacturers that came out had some decent reports. And then you have other companies, Ford, General Motors, who had horrible earnings reports, of course, because of the tariffs and the impact that's having on their business. Yeah, and which is amazing because there was a huge run up in purchases for vehicles as we approach the tariff implementations. And there's a lot of studies going on right now looking at just how much debt Americans went into to buy all these cars in advance, and now they're stuck with high car payments, $1,000 a month car payments when they wouldn't have done that otherwise. So it's impacting a lot of different things. The other thing that's being impacted on the earnings front is a lot of companies are pulling out or are pulling their forward guidance. Great example of that this morning was Steve Madden, the shoe company. You know, obviously do a lot of manufacturing in China, so they're going to be heavily impacted. Well, a couple of months ago, their forward guidance was looking for 20% growth year over year in 2025. They just came out and pulled their guidance, said, we have no idea what we're going to do, so we're not going to even take a chance on forecasting.
So does that, in your mind, with positive and negative mixed reviews and mixed earnings reports, negatives outweigh more than a positive. So in your mind, do you feel that that's trending then towards a negative GDP for the second quarter?
Yeah, I think that definitely is. So one of the effects that people may not realize is we just talked about everybody was pushing their purchases forward, right? We're buying stuff in advance because we fear the impact of the tariffs. Well, essentially what that did was that pulled growth from the second quarter into the first quarter.
And it still didn't make it positive.
So all that consumption, and it still didn't make it positive, that leaves a bigger hole to dig out of in the second quarter. So it's almost impossible now at this point for the second quarter to not be negative, absent some huge impact. And we don't know, that's always possible, but not really likely.
Given the situation, and then and that huge impact isn't a unemployment rate, because that's a lag indicator, right? We shouldn't be getting excited that unemployment was the same as last quarter. That's not something to get excited about. That just says it hasn't happened yet, because that would be one of the last things that you're going to see as a result from the tariffs and negative GDP, right?
Absolutely. And that's one of the lessons that employers have learned. post-pandemic was don't let go of your employees until you absolutely have to.
Right.
You know, and so remember we had at one point 2 job openings for every unemployed person because nobody was letting go of anybody because they were afraid they wouldn't be able to hire anybody. Well, they still have that mindset, but now going into a weakening economy, slowing sales,
Right, it's going to shift,
and problems with supply chains that are coming in. All these things, they're going to start letting people go. They're going to have to start laying people off, or they're going to be going out of business.
When profits start to go down, you're going to have to start tightening up who you keep and who you don't keep.
Absolutely. So as you said, you're exactly right. It's a lagging indicator. It's not a current, not concurrent. It's definitely lagging. You know, there's just not a lot of support out there in that area.
Do you find that optimism is kind of waning with that as well too? I mean, it seems like in the past 3-4 years, this overall optimism in the market that things are just going to get better, do better, be better, and will turn right back around.
Hope.
This concept of maybe, well, these tariffs are simply a negotiating token, and you know, countries are going to come to the table, we're going to make a deal. I mean, I understand that is, to use a Transformers term, an Optimus Prime type scenario. But I mean, do we find from a reflexivity standpoint, I know you look at the behavioral aspects of the market, do we see that the market's reacting as if things like that are going to happen, where there could be more downside if it doesn't come true? Or Tim's, magic bean rebound here? Like, what's your sense of that?
Yeah, I think that's what we've seen already, is that buy the dip mentality came back in, and that's why we had a big sell-off. You know, the Mag 7 was down 30%, the S&P was down almost 20%, and then there was a slightly positive move on the part of the administration saying we're going to pause the tariffs for 90 days, and all of a sudden the sun was out again and everything was great and people were buying back in. So that buy the dip mentality came back in, but it certainly has lost momentum at this point. That will continue to happen as we start to face things like a lack of goods on shelves because there are no boats coming from China, with these goods on.
Yeah.
The Port of Los Angeles, the Port of Long Beach are virtual ghost towns. Is what's being reported now. Ships that are coming from China are only half full. So there's going to be missing goods. And I know of people here in Miami that had manufacturing businesses, that they were manufacturing everything in China, and they rushed everything to produce a year's worth of inventory, get it here in the United States ahead of the tariffs, and now they've told their people in China, okay, thank you, take the rest of the year off.
Yeah.
Because I got nothing. I got no more orders for you.
That's an interesting tell also. I mean, if that is across industry, obviously we're talking about a niche scenario of one person you happen to know in South Florida that has business overseas. But if other folks are planning 12 months in advance and not 3 to 6 months in advance, that's quite telling as to what the CEOs of the world might be saying about their belief of how long or short standing these tariffs or this trade war negotiation might actually take place, or it might take, if you will.
Yeah.
So
right, absolutely. We just had last month we had one of the widest, I should say. I haven't checked the whole history, but the trade deficit was massive last month because everything was being imported and there was no exports going out. Now all those imports are here. And there's businesses that are calling their suppliers and saying, no, just hold that shipment there in the port in China.
Yeah.
Don't ship it, or just turn the boat around. And these carriers are requiring full payment in advance now.
Oh, wow.
For shipments because people are canceling their shipments midway, and these carriers, are left holding the bag.
Well, Ron,
so there's a lot going on here behind the scenes that we haven't felt quite yet.
We've got about 30 to 40 seconds here, and I wanted to get one quick idea in from you. Is there like a sector or a corner of the market that is looking okay right now? I mean, is it just as simple to avoid China, or how does one navigate this?
No, there's not really a particular sector that's outstanding. I would say that a hiding place is still large cap growth stocks are they have the best balance sheets. So what we'll be looking at is quality growth. So businesses that have strong balance sheets, but beyond that, just defensive sectors and cash.
What about gold? Gold, silver, precious metals?
You're right. Yeah, gold has had a great run up, and we participated in that. It has had some fluctuations of late, but gold is inherently linked to the dollar, and there is a capital move. So people are selling their United States-based assets, and they're pulling things back into international waters, right, into the other countries. And as they do that, that puts pressure on the dollar, and as the dollar goes down, and it's sunk quite considerably in the last couple of months, that lifts gold. And so that's why we have that. We have about a 10% allocation in our strategic allocation strategy to gold for that very reason.
Awesome. Always appreciate the insights, Ron. Thanks, Tim and Corinne. We're going to take a quick break here. Hey guys, welcome to the Greenlight Retirement Show. I'm your host, Brian Lindbergh, and we got Tim and Corinne Fitzwilliams here. How are you guys doing today?
Good, Brian. What's going on?
Oh,
Doing good.
What is going on is consumer confidence these days. It is,
Yeah.
It's been all over the news. You know, we're talking about inflation again these days. We're talking about recession a little bit as well too. You know, what are you hearing out there, Tim, in the world of econ?
Yeah, well, let's start with the facts, right? So first quarter, GDP is down 0.3%, which is negative, which means that we're 50% through the characteristics of a recession.
Sure.
So we need one more quarter, and then we're officially in a recession. People see that unemployment rate really didn't change from the previous quarter, so it hit expectations. But that means absolutely nothing, as that's a lag indicator. It's going to come out after the fact. You're going to see that effect later. You also saw that large companies bought stock in the first quarter, and you still had lower GDP. So that means that consumer spending was shakier than we originally thought. So now, moving into the second quarter, that large spending is not going to be there because it was already spent to buy inventory, and consumer spending is even more shakier as we're starting to now see the first results of the tariffs. So that's, my prediction, means that we're going to have a negative quarter again, thus putting us square in recession territory. And then later, after that, businesses will have to make changes internally because of the tariffs, because of the cost of goods going up. And that's finally when you'll see the lag indicator of unemployment changing. So it's all complex and complicated because you can't really fix it. You can't just say, I'm going to raise interest rates to make the value of the dollar stronger. And you can't lower it either to stimulate. So you're in this situation where you have what's called stagflation because consumer confidence is fading and prices are going up. So that's a unique combination. We just have to weather this storm. Remember, what do you see as far as consumer confidence? Like, you know, when people are buying things, do you feel like you're noticing a trend on apps being more expensive? Have you noticed any tariffs or costs?
So there's definitely a trend of people holding off on their spending for small items that they don't really need, like the Temu purchases, the Amazon purchases. But it also is affecting larger purchases, like people's air conditioning needing to be replaced or building that pool that our clients talk about, because all of the parts that they need have tariffs on them. So the price for the items that they'd been planning for months is now 7 to 10% higher.
Yeah, so that's a good point. As prices are growing, your current budget, your current setup savings plan, if you will, may not be enough to get what you want. So that's going to not only hurt consumer confidence.
Well, that brings into another economic term right here. When people stop buying things, they call that demand destruction, right? And so when that happens, you actually start to get price deflation, which, you know, could be helpful in an inflationary environment, but depending on which items are going to be experiencing that deflation.
I think it would be better than the opposite, which I hope doesn't happen, is that people say, you know what, I don't care, I worked hard, I want this no matter what, it stretches my budget. Because then that puts you out of your means as a whole, and that's just bad as a whole for the consumer, society as a whole.
Well, so does that mean that you're not traveling right now? Like, I just retired, I got my last paycheck. Like, how do I handle this situation?
Yeah, absolutely. I mean, with the market news, I mean, you do need to have a plan.
Yeah.
And I hate to be the bearer of bad news, but all our indicators are saying that it's not just going to be some jump back fix. You know, we're not just going to jump right back like we did in COVID. It's not just going to all smooth out. It's not just going to, you know, our experts are constantly talking about how we're actually have our finger on the trigger to continue to hedge in our investment portfolio because there's a constant amount of volatility and we don't see that letting up. So it could affect your psychology on whether or not you want to buy that plane ticket to go to Rome for a vacation or whatever it may be.
Got it. That sounds interesting for those that are in this environment or retiring right now and still have some hopes, dreams, and goals out there. I mean, is it as simple as just waiting? I mean, is it more complex planning that needs to be done? I mean, I'm only young enough and healthy enough, is what a lot of our clients say, you know, to retire right now. Or do I look to compromise elsewhere in my budget for things? Like, what are you seeing as the trend when you're talking to clients? I think it
brings up a good point is where can you win?
Yeah.
So like what sectors are actually getting growth, what sectors are not, and what is actually making sense right now. And you know, tactical and active management is what's making sense. Being able to pivot whenever you need to, getting yourself out of over leveraged things is what our experts are doing, what our chartered financial analyst is saying.
Yeah. So
do you have any insight as to sectors as well, like good spots that consumers can be in?
I mean, to shy away from making a personal recommendation here on our show, I'd say it's a little bit individualized. I'll say that, you know, the better things, the more things that you can do that are avoiding those things with tariffs right now with the uncertainty, probably the better there. You know, as you mentioned, we lean on Ron, our chartered financial analyst, to find those corners of the market that are doing the best.
So we'll bring that up in our next segment when he's on with us.
Yeah, we'll have to ask.
Because I'd like to hear what he has to say as far as what sectors are good right now for growth. Where is the place to make money?
Something I am comfortable saying right now, and ways that people can be defensive without a whole lot of tactic, is cash is still making 4%, you know, around, and you know, and if we're going to go sideways from here, we're not going to see a lot of good news. You mentioned, hey, there's probably not good news to drive us higher right now. Well, if that means we could go sideways to down, which is kind of the concern, well, in the sideways scenario, 4% isn't awful, right? You know, if you're going to be exposed to risk and you're going to have equities that have a high probability to be more volatile, you know, something, you know, more stable is a decent hedge, although it's not a traditional.
We talked about real estate a couple shows ago as that being a pocket that probably wouldn't be affected. So far, it seems like it hasn't really been affected.
Yeah,
because it's the interest rate risk that's there, that's still been there, right? It hasn't really changed, and we can't change it.
I suppose it depends on where you're at a little bit in the real estate as well, too. Well, another good question for Ron is we had some concerns about commercial real estate, more so than residential real estate, somewhat recently. So something that we can talk about as well, too. Again, always getting with that expert in the real estate arena there. But real assets are a hedge on volatility. They tend to be a little less volatile. I mean, we did go through 2008. Everybody listening to the show is probably old enough to have been there. So it's not perfectly immune or perfectly safe. These are all investments, and investments bear their own risks. You know, but you know, real assets like even gold and silver are decent hedges. Gold's been on a tear as well too. But I think to your points, more so just figuring it out where you need to be in your budget. Most people's vacations aren't going to take up 25, 30, 40, 50% of their overall net worth. So you're probably still safe enough to go on vacations and do some of the discretionary spending, depending on your budget. But that's between...
But those are isolated spends, right? Those are like one-time lump sums. I think to Corinne's point earlier, if you're looking at more of a monthly expenditure through a financing model, buying a car, putting it in a pool, putting that garage on your house, redoing your roof, whatever it is, something of that nature. If you're not paying full in cash, and I'm not recommending you to pay full in cash by any means. I'm actually not a fan of buying a depreciating asset with cash like a car. However, your budget will be affected, you know, if when you're adding on an extra bill. It's common sense, right? So are people scared to add on an extra bill right now with the uncertainty of the market?
Too.
And that's what the GDP is showing. People are scared to add on that extra bill.
Yeah, definitely. And as they're afraid of adding these extra bills, there's a lot of people that are also afraid to make a change in their current market situation. They freeze up. They don't want to make any changes.
Yeah, that's a really good point. The question is, should you not move, transfer funds, roll over because you're down and just wait for it to come back? And our argument is it's better to get out now if you're going into a strategy with an advanced person that understands tactical and active management. So if you're looking at should I go out and not go out, if you're talking to a professional and they have tactical and active management, they're rebalancing like a weekly basis like we do, well, then it could be a decent idea to get out and to move into something so you can catch the ride up.
It's all about managing your risk tolerance, your individualized strategy, and where you're at in your stage of life. There's plenty of people that are just fine holding their course. There's some people that might need to make moves into de-risk. Those are some things that you can get with us at Fitzwilliams Financial. Give us a call, 757-961-0700. Hey guys, and welcome back. I'm your host, Brian, with the Greenlight Retirement Show. We've got here Mr. Tim and Corinne Fitzwilliams. How are you guys doing?
Good.
Great.
All right. So we wanted to expand on what we were talking about last time and dig in a little bit deeper, some strategic ideas. We've got this interesting economic landscape out there right now. We've got higher than regular inflation. Interest rates are above, the bar that was set, post great financial crisis. We've got consumer confidence in the tank right now. Tim, get us started. What are some strategies that we should be considering at times like these?
Well, I think first we have to look at the basics, right? So we started building a house. So the bottom line is going to be your foundation. Your foundation is going to be your budget. Establish a budget. Make sure that you understand what you can spend and what you can't spend so that you can have confidence in your spending to include your investing. Mm-hmm. Then after you have your budget in play, you're going to have a portion of that of what you want to invest in. And then from there, you can go down the gambit. And we like to do this at our dinner seminars where we do an asset class bingo type thing. And we're not going to do bingo right now, and we're not going to do the whole thing, but we're just going to take a snippet of it, Brian. So let's just maybe go back and forth on some different asset classes and what they can do, right? So as a simple model, we're just looking at how they were designed. What does the book say? Textbook. Anybody could really
I hope I get these right.
Look this up and answer, right? It's not opinionated. It's not investment advice. We're just looking up to tell you, hey, this is what...
Yeah, even more pressure.
The design is. There you go. That's right. So we'll start with the most simplest one that everyone knows about, everyone hears about, stocks. So are they designed for growth?
Sure are, yeah.
Okay. Are they designed for income?
Can be, yeah. Dividends.
Okay. Mm-hmm. So that could be a wealth building strategy, is to look at individual stocks.
Yeah, that's actually a really good thing in a landscape like this, the total return concept. When volatile stocks are more volatile than ever, growth has a question mark associated with it. Getting a stock that pays a dividend, it's a decent time.
And that's something that we pride ourselves on, is we have a strong income portfolio built by Ron,
yeah, our charter
CFA.
financial. Yeah, absolutely. Yep.
Powerful. So then going right down the line, bonds. What are bonds? Bonds are debt instruments, right? Yeah. So are they good for growth?
No, not in today's modern era of investing.
Right. No. And are they good for income?
It's the definition.
Right. That's the whole idea, right?
Interest payment, yeah.
Yeah. So a lot of people use bonds as a hedge, right?
Sure.
As a safety net, because it's more of a secure model. It's not necessarily secured from market volatility.
Nope.
But it is more of a secured model than how people would look at stocks.
Lower risk, generally.
Lower risk.
Yeah.
Okay, well, let's change out of the market, because there's other things out there like real estate.
Sure.
So is real estate designed for growth?
Yeah.
Yes.
Yeah, absolutely, right? Mm-hmm. It's great for growth. There's always some type of appreciation factor depending on where you live. So that's nice. Real estate designed for income.
Yeah.
Yes.
Absolutely. I always say this as a trick question. What do you think wealthy people like more, growth or income?
Income.
Absolutely.
Income.
Income is the key, folks. It's not about how much you have. It's about what you make.
You reminded me, and I was letting Corinne answer the real estate income, because you reminded me of when you guys first got one of your first couple rental properties.
Yeah.
You guys went to Vegas. And Tim already knows the story. Yeah. And Corinne's shopping
Corinne,
around
you want
Vegas.
to share that story real quick?
Tell us about the shoes.
first of all, for those of you that are not common listeners or friends of ours, Tim and I are like fine china and paper plates. He is the Rolex watch, and I am the Apple Watch if I have to wear a watch. So I don't wear fancy business stuff the way that he does, because we dress for the job that we want, and I want to be at Target. So we're in Vegas, and he's like, let's go to these shops and just, look around. He's at Ferragamo. We're visiting Coach and Gucci and all these other stores. And there's this company called Jimmy Choo, which is a shoe brand that I've always admired. I've thought they were, pretty fancy and cute. And so we went into the Jimmy Choo store, and I have huge monster feet. I wear a 10.5. Brian, your wife has big feet like me, so you know. When you go into a store and you're looking for big shoes, they don't usually have the sizes you want. So I thought we were just window shopping, and I found these gorgeous shoes, and I was like, oh, these are so pretty. I'd probably wear them like once in my whole life. How much are they? And they're like $800 or $600. And I was like
$8.
And I was like, oh, thank you. Put them back. And Tim was like, look, that's basically the profit we made off of our rentals. Like, if you want them,
This is when we first started our
just
rental.
buy them.
Yeah, no, it was one of your first
was my
your
first
first
ones, yeah.
triplex or
And
something like that.
I was just like shocked, because it's not in my nature to spend that kind of money on something like a pair of shoes. And we did. We bought
I think it's a great
pair of
story,
shoes.
though. And what I want everybody to take from that is, having a lot of experience with folks that are, at least moderately affluent, or maybe not even having the most money. The money that you spend the most freely is the paycheck money. It's
That's
the
right.
income.
Spend your cash flow.
Yeah, spend
Don't
your cash
spend your
flow.
savings. That's
and
right.
so when
You
you
invest
take
your savings.
we bring it back to Tim's original question, what do you think the affluent do, or what do they prefer, spending their assets or their income? And they absolutely spend their income on these luxury items. So
right.
whenever you see a truly wealthy person with the designer, whatever it is, or the car that you might admire or look up to, look after, they probably own an asset that is paying for those luxury goods. So I love that, because it's a nice little window inside of, what the truly wealthy do and how real wealth is created, and it's created
Absolutely.
on copious amounts of income.
Yeah, 100% true. Going right on down the lines,
Oh,
we got annuities.
forgot about that detour we took.
Yeah, no, it's a good detour,
annuities.
though, because I think it's important to really point out it's not just the market.
Yeah.
Right? You can make income from a lot of different things. And it's not that hard to get into if you know how to get into it. And there's plenty of podcasts out there that talk about real estate for sure.
Yeah,
and
we
the
don't
Burr
need to
method and
double
all
up on
that. But annuities, right? So
Yeah.
annuities,
I love annuities.
sure, yeah, because they have some interesting characteristics if you understand how they work. And so they're designed for growth, yes or no?
Yeah, they can be designed for growth.
Most of them, yeah.
Yeah, absolutely. They can be designed for growth. Are they designed for income?
Some of
the
them.
legal definition of an annuity is like a pension.
Yeah,
so
your
it's-
pension, right? So
it's an
therefore it is
vehicle for
income,
sure.
yeah. But I think what is important to get into one more characteristic so people don't just start getting confused. They're not liquid. I had a lady last night who was like, yeah, but they're partially liquid. I could take 10% out. And I was like, you may be able to take 10, you may be able to take 20, you may be able to take 7. That's all from the company. But from a legal definition, they're not a liquid asset.
Yeah,
No.
definitely
Yeah.
not.
Well, then that brings us to our friends CDs. Gotta
Yeah.
love the bankers out there.
Yeah.
So are they designed for growth?
Heck no.
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 Are they designed for income?
Nope.
No. And by the way, fun fact, they're also not liquid.
Yeah, also not liquid. When you get a clawback of the interest earned as a sort of walkaway penalty, it's not fully liquid.
So there's a few different ideas of what can be growth and what can be income, whether you're in the market or out of the market, right? Some interesting solutions. And of course, you can contact your financial professional, your advisor that you're working with, and just really kind of go over it. I will say this, if your advisor is not comfortable talking about a holistic approach about everything, I'm not saying that that's bad. I just think people should have someone that is well-rounded
Yeah.
and is able to talk about all those things with experience behind it. That's something I really pride ourselves on, Corinne, and what we build is that holistic feel by having everything in one shop, right?
Yeah.
And not so much to plug ourselves, but really passionate about the fact of bringing Wall Street to Main Street.
Yeah.
One stop to get it all done.
And I also like the idea of it's good to meet with somebody that has knowledge in all areas.
Right.
Sure.
But it's also nice when you're at an office like ours, because when you mentioned annuities, I was like, I love annuities. But not everyone in our office would feel the exact same way. And I think it's important when you're meeting with people that you make sure that it's a diverse
Right.
information
Yeah.
that you're getting. You're not meeting with somebody that's like, oh yeah, I can tell you about all these things, but what I really want to talk to you about is life insurance.
Well, that's the
Like,
difference of a fiduciary, right? So
Well,
that's a very good point
I want
right
to pause there real quick because it sounds like for the listener, I want to make sure that they understand. It sounds like to Tim's point, the firm can do everything. It can do investments, insurance. It can do retirement planning, budget, long-term care, life insurance, legacy,
lawn care.
there. Taxes.
taxes,
Real estate.
connections with estate planning. But Corinne, what I hear you saying is our firm doesn't necessarily need to be all things to you. You can simply,
That's right.
You could simply be the insurance. We could be your insurance advisor. We could be
Absolutely.
simply your investment advisor. We could be simply your tax advisor.
Well, our main core competency is retirement planning.
Yeah.
And so I think that's really important to understand in today's model with the economy the way it is. Retirement planning is more important than ever.
Yeah.
And that's why I think people should look at ideas like annuities and not just hear, oh, I heard it's so expensive. There are all different types. And so
Well, I
if
think
you're
the
walking out of
point-
your job, and you're getting that last paycheck, you need income. An annuity might be great. And so be open-minded. Don't just think it's bad. If it's bad, it'd be illegal and it wouldn't be sold.
Sure. So again, this whole second opinion thing that you're kind of throwing out there, like you might have a relationship, you might not, but if you do, this is just a simple second opinion. Tim,
Question, I
do
forgot
you
what it
charge
was.
for that? I mean, right now you've made a great presentation of sorts. Like, hey, well, you can do it all. You don't have to be all things to all people. Just come on in for a second opinion. For the listener out there, I mean, do you charge for that?
No, we don't. We don't charge for that. And I think it's important that people do get a second opinion and then you stay open-minded during that second opinion. And we need to identify, do you have a gap in income? Do you have a need for something? Because here's a reality that a lot of people don't really internalize.
Yeah.
Your 401k, whether you like it or not, is going to end up being income, either to you or to your kids. So you might as well start looking at a model of trying to somewhat start the income, because the taxes are at a lower rate now than they're going to be later. So it's important to look at retirement plans. It's important to look at your IRA not as a nest egg, because it's the worst dollar you can leave to your kids, but rather as a source of income.
You said an important point there, and if the listener maybe isn't up to speed on some of the financial planning news, I just want to make a mention. The IRS and the government in general came out and said your IRA is no longer a wealth transfer tool.
That's right.
They changed the law. The Secure Act came out. Your IRA is no longer a wealth transfer tool. If that's the first time you're hearing that, you really need to give us a call so we can help you understand that better. 757-961-0700. You have to understand that IRA is really not a good wealth transfer tool at all. With that, folks, we will take a short break here. We'll come back and we'll talk to you a little bit more about a client and a client story where these principles kind of come home and they kind of meet, and hopefully you guys can take a little example from that for you as you come in for your second opinion with us. 757-961-0700. Hey guys, welcome back. I'm your host, Brian, on the Greenlight Retirement Show. Here we got Tim and Corinne Fitzwilliams. Hey guys, so we wanted to talk a little bit about a client story that kind of brings these segments together. In this period of inflation, cost of goods going up, declining consumer confidence, tax concerns, budgetary concerns. We wanted to share with you a little story, client story, about how we were able to design a strategy to really kind of mitigate a lot of the concern here. So, Tim, you want to kick us off? And
Yeah,
give us a little
I
bit
think
of
it starts with
background?
concern is relative.
Sure.
Depending on the planning that you've done.
Yeah.
I've got plenty of clients that aren't concerned at all.
Yeah.
Could care less.
Okay.
You know what? They decided to take their IRA, turn it into an income stream, live life to its fullest, and whatever they don't spend, reinvest back into the marketplace. So their concerns are only for the extra fluff money that's left over, as we call it.
Yeah.
Right? They're sitting fine. They've got their income coming in. They're not worried about consumer confidence. They're not worried about the stock market. They're not worried about any of that because they've converted their nest egg that they did have. Instead of it looking at it as a nest egg and it's staying solid and, oh, look at that number, let me watch it grow, they actually did something with it.
Yeah.
And they turned it into income, and that's a beautiful thing. And not only is it income, it's income that they can't outlive.
Yeah.
So they can live their whole life, and I say they because the husband can live his whole life, he can die, and it's set up in such a way that's going to go to the wife and continue to pay her for the rest of her life as well. And if they run out of money from the IRA in the process, well, it doesn't matter. They're still going to get a paycheck. So again, I don't think everyone is concerned. I think everyone listening should be concerned if you don't have a strategic plan. So what is that plan, and what can you do? Well, just like our client, you can execute an income-based strategy. And I personally like the idea of doing that with an out-of-the-market model like an annuity.
So, Corinne, from your experience, do these type of clients, do they shy away from these discretionary purchases? Do they shy away from vacations, or do they just kind of push forward with them?
Most of them just push forward with them. You know, it's in their plans. They've already sat down with us. They know what they have and how much they can spend each month, and they don't have as much of a concern about taking vacations and doing that kind of stuff.
Remember the one client that was able to go to Israel because we set it up like this?
Yeah.
There was market volatility?
Yeah.
But because we set up their IRAs like this, which at first they were kind of hesitant. They're like, I don't know if I want to do that. But then they're like, wait, I can just take this extra money I never had and just go to Israel and do all the things I want to do?
Yeah.
And they got to do it before health concerns came in.
Yep.
And I think that's just fantastic. That's such a blessing to be able to live your life to your fullest. Again, people are looking at that IRA as this big nest egg, as this bank account that they saved up all this money, and that is not what it is. Why did you work? What was the point?
So, Tim, from your experience, do most of these people, when they consider an income vehicle or income strategy like this, do they just do the enough to get them back to their fixed expenses, or do they do a little bit extra so they can sort of insulate some of their discretionary expenses? What are most people doing these days?
It's kind of shared. I mean, our proposition and what we try to tell people to do is at least cover your fixed expenses as best you possibly can. So then you don't have to worry. Worry comes in bills. Finance stresses people out. When you don't have the money to pay your bills, that's an issue. So if you're leaving your job, you're making $200,000 a year, and you saved up $2 million, and you walk out and you're not getting a paycheck the next week, what do you do? Oh, I'm gonna be okay. I'm gonna live off my 401. Well, you shouldn't look at it that way. Just by saying that, you need to have a plan on how you're going to live off your 401k, and then from there it's, well, live. Am I going to your point, live by just having my bills paid for, or am I going to also include a little bit more? I personally like the idea of including more, only because if you don't spend it, just reinvest it. But at least you're converting the tax dollars, which I'm a huge fan of. As we all know, our firm believes the taxes are definitely going up.
Well, I think I heard a little something in there. If we're going to combine a couple of our conversations and points today, we heard your family story about how Corinne was able to kind of splurge on a pair of shoes because she had surplus cash flow. And so I also hear Corinne saying, like, most of these clients aren't really concerned to spend some of their money on discretionary income because it's just income flow. So when you set yourself up with a cash flow strategy like this,
Tim, that's the key. The income strategy, absolutely. Whether it's the rental, whether it's the annuity, the dividends, whatever your cup of tea is, in the market, out of the market, business investment, whatever, I think that it's important to have an income strategy, for sure.
Yeah, you will not be spending the asset, just spending the income. That income will be there next month, so you can feel more free to do those things. The other thing that I hear inside of these comments is when you fund your financial plan from an income point, so you know that this is the income that you need. It sounds like if you're blessed to have other dollars as well too, it then frees you to do additional or second level planning like tax planning, legacy planning, charitable giving, and
right.
factors
I mean, Corinne,
like
you
that.
deal a lot with the legacy planning. When you see that people are under this duress, right, especially for widows and widowers, what do you find? You know, that they have more confidence and calmness when there was a executed income plan, or they're not really worried about it?
So it's a It's a tricky situation because a lot of our female clients come to us because the husband was the person that managed everything. So when the husband passes away, there's a lot of worry, a lot of lack of understanding. So they do have a fear. And a lot of that is because when we sit down with clients, we educate people so much that they know what they have, and the husband might, be on the same page as you, and the woman is just confident and she knows just enough to know that she's good. Mm-hmm. But then when the husband passes away, she's like, I don't know all of this. So there's maybe a couple minutes of worry there, but once we, kind of show her more of what it is that we had planned for them and where she's currently at, it's kind of freeing for them to be like, I don't have to worry about this. I don't have to stress about this. You guys have already taken care of the income issues and the taking care of my kids and grandkids and all that. So it's hard because not all women, I hate to say that, but not all women that are our clients from the beginning want to know everything.
Sure. That's a decent segue for something I wanted to kind of wrap up, Tim, with is give the listener a quick idea of what the appointment process looks like if they're going to come in and get this second opinion.
Yeah, absolutely. So for us, the first appointment is just coming in and we're gathering data. We're just getting to know you. We're looking at statements. Maybe we're looking at tax returns. You're sitting down with a relationship manager and we're kind of gathering data. Then from there, we're going to take that set data and we're going to go back with our planning committee and we're going to analyze that and we're going to build a plan. And it's really a 6-part analysis. We're going to look at investments. We're going to look at your risk tolerance. We're going to look at budget. We're going to look at how inflation affects things. We're going to look at tax models, and if that's a concern for you, we'll look at long-term care. We'll look at when to have Social Security, when to not take Social Security. We'll look at estate planning. We're going to look at all these various factors, right, that can affect your financial plan, and we're going to give you a written plan. Now, we're not going to give you the plan from a standpoint of you can take it home. You're going to be able to understand it. So if you want to have a second opinion, if you want to have a written plan in your life, give us a call, 757-961-0700.